Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within financial reports. Today, we're diving into a quarterly report from Ispire Technology Incorporated, and let me tell you, this one has some interesting shifts and numbers that paint a picture of a company navigating some choppy waters. So, what is the big story here? Ispire Technology. A player in the vaping industry is reporting its financial results for the quarter ending the 31st of December 2025. We'll be looking closely at their revenue, expenses, and what is happening with their cash. Plus, we'll unpack some of the risks they're facing and what it all means for their future. And hey, before we jump in, if you are looking for more of these deep dives into company filings without the corporate jargon, make sure you are subscribed. Also, join our Discord community, link in the description for more discussions and insights. Alright, let's get straight into it. This filing, a Form 10Q, gives us a snapshot of Ispire's financial health for the 3 and 6 months ending the 31st of December 2025 compared to the same periods in 2024. Think of it as a progress report, and sometimes those reports have good news and sometimes they show areas where improvement is needed. First up, we'll check out the balance sheet. This tells us what the company owns, what it owes, and what its owner's stake is at a specific point in time. Looking at the assets, we see their cash has decreased from over $24 million at the beginning of the fiscal year to about $17.5 million by the end of December. That is a noticeable drop. Their accounts receivable, which is money owed to them by customers, also went down a bit. Overall, total assets have decreased, which is not usually a sign of rapid growth. Now, let's look at the other side of the balance sheet liabilities. Total liabilities have seen a decrease as well, going from over $101 million in June to just under $92 million in December. This is a positive sign that they are reducing their debt or payments owed. But here is where things get a bit concerning. The company's stockholders' equity has swung from a positive $604,000 in June to a negative $7.6 million by December. This means, based on accounting rules, that the company's liabilities now exceed its assets, resulting in a deficit in stockholders' equity. This can sometimes indicate financial distress, though it is important to look at the full picture. Moving on to the income statement, this is where we see how much money they made and spent, and whether they were profitable. Let's start with revenue, which is the total money earned from sales. For the 3 months ending the 31st of December 2025, revenue was about $20.3 million, a significant drop from over $41.8 million in the same period last year. That is a decline of about 51% for the 6-month period. Revenue fell from over $81 million to around $50.6 million, down about 37%. This sharp decrease in sales is a major point of concern. The company mentions this is due to lower product sales in North America and Europe, citing market conditions and a focus on higher quality customers with shorter credit terms. Gross profit is what is left after subtracting the cost of making the products. Gross profit also dropped significantly. For the 3-month period, it fell from about $7.7 million to $3.5 million. And the gross margin percentage also dipped slightly from 18.5% to 17.1%. For the 6 months, gross profit went from almost $15.4 million to $8.6 million. With the margin shrinking from 19% to 17%, they attribute this margin decrease to a change in the mix of products being sold, with fewer higher margin products now making up their sales. This is the core operating loss. For the 3-month period, the loss from operations was higher at $6.9 million compared to $7.4 million last year. A slight improvement in the absolute loss amount, but a worsening as a percentage of revenue. For the 6-month period, the operating loss was $9.6 million last year. It is a mixed bag here, with the overall loss shrinking, but revenue also shrinking significantly. One line item that stands out is credit loss expenses. This is money set aside for customers who might not pay their bills. These expenses remained high, around $4.2 million for the 3-month period this year compared to last year. For the 6-month period, they decreased slightly from $7.3 million to $6 million. This indicates that the company is still facing challenges in collecting payments from some of its customers, which is often a sign of underlying financial weakness in their client base. Now, let's talk about general and administrative expenses. These are the costs of running the company, like salaries, rent, and legal fees. These expenses have decreased quite a bit, going from over $15 million for the 6 months in 2024 to about $18.2 million in 2025. A big chunk of this decrease is due to reduced payroll and stock, base compensation in North America, and general cost cutting measures. This is a positive move. showing they are trying to control their overhead. And finally, the bottom line net loss for the 3 months ending the 31st of December 2025. The net loss was about $6.6 million, an improvement from a loss of nearly $8 million in the prior year. For the 6-month period, the net loss was $9.9 million, also an improvement from $13.6 million in the prior year. So, while they're still losing money, they are losing less money, which is a step in the right direction. Let's quickly look at the cash flow statement. This tells us where the company's cash is coming from and going to. For the 6 months ending the 31st of December 2025, the company used about $5.2 million in cash from its operating activities. This is a stark contrast to the slight positive cash flow of about $428,000 in the same period last year. This change is largely due to the decrease in revenue and the increased accounts receivable that they are not collecting. This is a significant warning sign about their ability to generate cash from their core business. Investing activities show where they are putting their money besides their main operations. They spent about $903,000 on investing activities in the first 6 months of 2025, mainly on their joint venture and capitalizing patents. Last year, they spent a bit more at $1.1 million. Financing activities deal with debt and equity. In the first 6 months of 2025, they used about $683,000 for financing, primarily for repaying borrowings. Last year, they had no cash outflow for financing, but their overall cash position was better. With all these outflows, it's no surprise that their total cash and restricted cash at the end of December 2025 fell to about $17.6 million from over $24.3 million at the start of the period. Now, let's touch on something important: related party transactions. A significant portion of Ispire's purchases, over 94%, come from a supplier named Shenzhen Yijie. Here is the key. Shenzhen Yijie is 95% owned by the company's chairman and co-chief executive officer. This means a huge chunk of their spending goes to a company controlled by their own leadership. This raises questions about whether they are getting the best deals or if there are potential conflicts of interest. The accounts payable to this related party are substantial, reaching over $42 million at the end of December 2025. They also have a significant amount due to this related party, $29 million. Which has been deferred for repayment. Stock-based compensation is another area to note. The company grants stock options and restricted stock units, particularly to employees and management. While this is a common practice to incentivize employees, the significant expenses associated with it did decrease from the prior year, which aligns with their efforts to reduce general and administrative costs. They still have a considerable amount of unrecognized compensation expense, over $4.6 million. That will be recognized in future periods. Finally, let's look at controls and procedures. The company acknowledges that its disclosure controls and procedures were not effective as of the 31st of December 2025. They cite a lack of controls for evaluating significant estimates like inventory and credit loss reserves, a shortage of personnel with adequate accounting knowledge for complex US GAAP issues, and insufficient general controls. This is a serious admission, suggesting potential weaknesses in how they manage their financial reporting, which could lead to errors or misstatements in the future. So, what is the verdict on Ispire Technology Incorporated? The company is clearly facing significant challenges. Revenue is down sharply, their balance sheet shows a deficit in stockholders' equity, and cash flow from operations has turned negative, while they've managed to reduce some operating expenses and their net loss has narrowed. These improvements are largely occurring in a context of shrinking sales. The heavy reliance on a related party supplier and the acknowledged weaknesses in internal controls are red flags that investors and stakeholders will want to watch very closely. The company's strategy seems to be shifting towards higher quality clients and cost cutting, but the substantial revenue decline suggests that the market is not currently responding favorably, or that external factors are having a significant impact. The path forward looks uncertain, and they will need to demonstrate a clear strategy to reverse these negative trends. Alright, that is our breakdown of Ispire Technology's latest quarterly report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.